So on Monday we have started this chapter, energy economics or financial management in energy sector. Okay, so we have started with the need of investments, why the investment is required. Then we have started with the financial analysis technique, which includes simple payback period. We have seen the formula, we have seen the example, we have seen advantage, disadvantage in a deep manner. After that we have seen time value of money, which is nothing but the present value and future value of money. And then we have seen return on investment. Okay, and the limitations of return on investment. Then we have seen net present value. Okay, we have seen the advantage of that. Today we are going to see the internal rate of return. Okay, so this internal rate of return is quite similar to the net present value. Okay, so basically this internal rate of return indicates the rate of return in terms of compound interest. Okay, rate of return of a project or something investment in terms of compound interest rate. Okay, so this is mostly concerned with the profitability. Okay, now this method of rate of return, internal rate of return, calculates the return of investment that the investment is expected to yield. Okay, so now this method expresses each investment alternative in terms of a rate of return, that is a compound interest rate. So now the expected rate of return is the interest rate for which total discounted benefits become just equal to the discounted cost. Okay, which means that net present benefits or net annual benefits are equal to 0, or for which the benefit or cost ratio equals to 1. Okay, so we are going to see how it is in the example. So the criteria for selection among the alternatives is to choose the investment with the highest rate of return. Okay, so here the thing required, as we have already seen in case of return on investment, if the return on investment is high, then the project can be chosen. Okay, if it is less, the project can be ignored. Same formula applies to this. Okay, the return on investment should be high. Okay, rate of return should be high. Now this rate of return is usually calculated by a process of trial and error. Okay, here we have to put some variables. Okay, random variables. Okay, not random but close to the interest rate. We have to put the variables and we are going to see whether our right hand side becomes uh, 1 or not. Okay, that is what we are going to see in the example. Now the internal rate of return, okay, of a project is a discount rate which makes its net present value equal to 0. Okay, so if we are going to study this internal rate of return, the formula is given here. Okay, this formula is quite similar to the net present value. Okay, so we already seen net present value equals to, now here this is the CF suffix T. This is only important. CF suffix T is the cash flow. Okay, and we already seen this K is the discount rate, and small t to the bracket, power of the bracket, is the uh, life of project or time period of the project, etc. Huh? So now this internal rate of return is quite similar to the net present value, just we have to make this net present value 0. Okay, we have to make this as 0 and this is the remaining as it is. Okay, if you can see here, for example, net present value has been kept as 0, other values are same as it is. And if you are going to see, the main thing is required is 0 equals to this summation of t equals to 0 to n, and this cash flow, okay, at the end of the year, and 1 plus k to the power t. Okay, k is the discount rate. Okay, and this n is the life of the project, and t is the year. Okay, first 0 year, first year, second year, third year, fourth year, etc. So now here we are going to manipulate the values of k. We are going to change the values of k from a range of variations of values, and then we are going to make this as less than the projected value. Okay, we are going to see the example बघितल्यावर तुम्हाला कळेल. hmm. So now this here in this case the cash flow value will be negative if it is expenditure, okay, and it will be positive if it is saving. Okay, so in case of saving the CFT value is positive, in case of expenditure, okay, that in that case it will be negative. Now there is an example, okay. So here in this case what we are going to do, in the net present value calculation we assume that the discount rate, okay, that is the cost of capital is known, and we are going to determine the net present value of the project. So now in case of internal rate of return value calculation, we set the net present value equal to 0. Already I said we are going to set this value, which is net present value, equals to 0, and we are going to determine the discount rate, okay, which is nothing but the internal rate of return, and we are going to see whether the net present value that are already given equals to it or not. If it is equaling, or if it is less than the value given, then the interest rate is suitable. If it is more than the value given, it is not suitable. Okay, so this is an example here. Okay, so this example consists of per year cash flow, okay, starting from year 0 to 4. So here if you are going to see this 0, it is showing you the CFT, okay, sorry, net present value. So this is the total capital investment, okay, as we have seen in the net present value, okay. So here investment they are given, that was the cash flow in the year 0 or time period of 0. So we have to take this as net present value for the year 0. The cash flow is 1 lakh. For year 1 it is 30,000, 20,000. For year 3 40, and year 4 45,000. Okay, now we have to equate the cash flow of the year 0, okay, at the net present value formula. So just write it here, 1 lakh equals to, now just make that thing, okay, this is the cash flow of the 0 year, so this will be cash flow of the 1 year. So now here CF0, CF1 and up to CFN, okay. So now n is only 4, so we are going to take only 3 4 values. So this is will be your CF1, CF2, CF3, CF4, okay, CF1, CF2 up to CFN. We are going to just change the or alter the discount rate K, okay. So we are going to write it as it is, okay. We are going to just equate the year, okay. So 1 2 3 and 4, okay. Now in this case we are going to keep the K, that is the discount rate, at 15%. So just put K equals to 0.15, because in that earlier net present value we have taken 10%, we have put 0.10 as 10% equivalent for 100%. So here we have to keep K value as 0.15, so it will become 1.15, okay. 1.15 power 1 1.15, then 1.15 to the power 2 becomes, okay, and so on. And it after equaling, okay, after addition of these terms we are going to get the value of this as more than the value of given value, okay. So what is the value given? 1 lakh. The value which we are obtaining by the sum is 1,0802,000, okay. So this is quite more than the respected value, so we have to again alter, okay. This is a trial error method. We are going to alter, we are going to change this rate of interest from 15% to 16%, okay, generally higher. So if the higher, okay, so in general a higher K lowers, okay, and a smaller K increases the right hand side value. So if you want to lower this value at the right hand side, okay, so currently it is 1,0802,000. If you want to keep it less than 1 lakh, we have to make the k higher. Okay, so we have to change the k from 1 point, sorry, 0.15 to 0.16. So after changing it, you are going to get the value of k, for the value of right hand side, which will be less than 1 lakh. So this is the exact or variable, which is expected rate of return. Okay, internal rate of return. So since this value is less than 1 lakh, we can conclude that the value of k lies between 15% and 16%. Okay, so that is the reason why, okay, we are going to use trial error method, and we are going to find out the variation of the value of k. So in this case, the variation of k ranges from 15% to 16%. Okay, that is the basic calculation. Okay, now this is about the internal rate of return. There is an example, so we are going to see the advantages. Okay, so this is a popular discounted cash flow method. Already it has several advantages, which are it takes the account of time value of money. Okay, so it can account the present value of money also, and the past value of money, sorry, future value of money also. So it also considers the cash flow stream. Now cash flow is very important in this case. Okay, without cash flow, calculation of this term is impossible. So it considers the cash flow, okay, stream. Now it also makes sense to businessmen who prefer to think in terms of rate of return and find an absolutely quantity like net present value, okay, somewhat difficult to work with. So we can alter between the net present value and internal rate of return value. Okay, if we are not happy with the net present value, we can work with the internal rate of return value. Okay, for this is very feasible for some businessmen. Okay, so now there are limitations, okay, disadvantages. Now this internal rate of return figure cannot distinguish between lending and borrowing. Okay, and hence a high internal rate of return did not necessarily be desirable feature. Okay, so already we have seen here what they are telling. They have told that there should be high return of rate of return. Okay, so in some cases it is not desirable feature, okay, to have always the high internal rate of return. Okay, so that is only the limitations. Mostly there are advantages of this method. Okay, so this was about the internal rate of return. Now we are going to see the next point. There is an example over here for internal rate of return. You can solve it on your own. I'll give you this in the assignment. Okay, now next is important is cash flows. Okay, we have already seen what is cash flow. Okay, we have seen in a very introductory manner. Okay, so cash flow is nothing but the input and output of the in sorry, input flow and output flow of the cash. Like input flow means spending of the cash, and output flow means the returns and the profits from the investments. Okay, so now we are going to see the cash flows in a deep manner. Okay, so generally there are two kinds of cash flow. First is the initial investment, okay, as one or more installments. So first is initial investment, okay, keep this in mind. And next is the saving arising from the investment. So investment and then saving, these are the basic two cash flows. So now there are other different cash flows which we are going to see. Okay, so there are usually other cash flows related to a project. Okay, these include the followings. Okay, we are going to see each and everything. So first is capital cost. Okay, here I'll highlight it, capital cost. So capital cost are the cost which are associated with the design, planning, installation and commissioning of the project. Okay, so these are basically one time cost unaffected by inflation or discount rate factors. So there is no in occurrence of any kind of inflation factors and discount rate factors, although as in the example, installments paid over a period of time will have time cost associated with them. Okay, that is the major concern. Next is annual cash flow. Now annual cash flow such as annual saving, okay, occurring from a project, okay, then occur each year over the life of the project. Okay, these include taxes, insurance, okay, then equipment leases. Okay, equipment leases means if you are going to keep the equipment on lease or borrow it for lease. Okay, then energy cost, okay, then servicing, then maintenance, then operating labor, and so on. So increases in any of these cost, okay, as I already said, represent negative cash flow. Okay, whereas decrease in the cost represent positive cash flow. Okay, so now factors that need to be considered in calculating annual cash flow. Okay, so for calculation of annual cash flow, what are the factors required? First of all, taxes. Okay, taxes using the marginal tax rate applied to the positive or negative cash flow. Okay, positive means increasing taxes or negative means decreasing taxes. Second is asset depreciation. Now the asset depreciation is the depreciation of plant assets over the life. Okay, plant assets over the life. Depreciation is a paper expense allocation. Okay, rather than a real cash flow. Okay, and therefore it is not included directly in the life cycle cost. But however, depreciation is a real expense in terms of tax calculation. So while calculation of the tax, depreciation is very important, and therefore does not have much impact on the tax calculation. Okay, so for example, if a 10 lakh rupee asset, okay, suppose there is an asset of 10 lakh rupees. Now if it is depreciated at 20%, okay, and the marginal tax rate is 40%, okay, then the depreciation would be 2 lakh, okay, and the tax cash flow will be 80,000, and in this later amount that would show up in the costing calculation. Okay, that is the asset depreciation. Okay, so these are the different cash flow, and we have already seen the different types of cash flows, capital cost and annual cash flows, and the factors which are going to find out the annual cash flows, okay, which are taxes and asset depreciation. Okay, so last part is the sensitivity and risk analysis, okay, that we are going to see today. Okay, so this includes the basic need of what sensitivity is and what risk analysis is, and then the micro and macro factor. Okay, we are going to see. So sensitivity and risk analysis. So many of the cash flow in the project are based on assumption. Okay, assumptions means some likings and some experiments. Okay, that have an element of uncertainty. Okay, so the present day cash flows such as capital cost. Okay, remember this. The present day cash flows are capital cost. I'll highlight it. Capital cost, then uh, energy saving, energy cost savings, then maintenance cost, okay, etc., can usually be estimated fairly accurately. Okay, this can be estimated in an accurate manner. But even though this cost can be predicted with some certainty, it should always be remembered that they are only estimates. Okay, so whatever we are going to estimate, these are only estimates, they are not exact values. Okay, so cash flows in the future years normally contain inflation components, okay, which are often guess, okay, guess estimates. Okay, we are going to see in the next part that guess estimates it. Okay, and the project life itself is an estimate that can vary significantly. Okay, so it is not a fixed value. Now sensitivity analysis is sorry, so sensitivity analysis is an assessment of risk. Okay, this is the most important part. It is an assessment of risk. Okay, because of the uncertainty in assigning values to the analysis. Okay, it is recommended that a sensitivity analysis be carried out particularly on projects where feasibility is marginal. So where feasibility is marginal, in that project we are going to find out the sensitivity analysis. How sensitivity is the project feasibility to changes in the input parameters that we are going to, that we need to have a look. Then what if one or more of the factors in the analysis is not as favorable as predicted, okay, or shown? Then again, how much would it have to be vary before the project becomes unviable, okay, that we need to look at. And what is the probability of these happenings? So these are the sensitivity analysis factors. Suppose for example that a feasible project, okay, the feasible project on an energy cost saving that escalates at 10% per year, okay, this is important, 10% per year escalation of a project, but a sensitivity analysis shows that break even is at 9%, okay. Now the project becomes unviable if the inflation of the energy cost falls below 9%, okay. So there is a high degree of risk associated with this kind of projects, so much, okay, so much greater than if the break even value was at 2%, okay. So it depends on the break even value, okay. So here break even value is at 9%, okay, and it will be a high degree of risk, okay, if even though it was at break even value of 2%. Now sensitivity analysis is undertaken to identify the parameters that are both uncertain and for which the project decision taken through, okay. So now here net present value and internal rate of return is important, okay, is sensitive. Now we are going to see the some micro and macro factor. There are difference, okay, in the word micro and macro factors which incorporate the sensitivity and risk analysis. So there are five micro factors, okay, which can alter the sensitivity and also manipulate the risk analysis. So first micro factor is operating expenses, okay. Operating expenses includes various expenses items like operating costs, processing costs, manufacturing costs, etc. Then capital structure, okay. Then cost of debt equity. Debt means loan, okay. Equity, okay. Equity means sharing of the percentage of company or ownership of the company. Then changing of the forms of finance, that is leasing. If you are going to lease some equipment, if you are going to put on lease some equipment, if you are going to take some equipment on lease, that also is crucial in case of risk management. Then changing the project duration. If you are going to change the duration of project, suppose it was earlier 1 year, now you are going to change it for 1 year 2 months, then the risk analysis and sensitivity might vary, okay. Now what are the macro factors, okay. So macro factors are important, okay, than the micro factors. These are the what you call it as long term. These are the short term or medium term, if possible, if you can overrelate. So macro factors are changes in the interest rate, okay. If the interest rate changes for the leasing amount or the debt we have carried, so it will also deteriorate the sensitivity and risk analysis, okay. Then changes in tax rates. Suppose in the last financial year GST was 18%. In this year it becomes more, okay. It arises from 18 to 20%. Then it can affect the sensitivity and risk analysis. Then the changes in the accounting standards, like, okay, and that is methods of calculating depreciation, okay. So this can also be affected in case of the sorry, in changing the sensitivity and risk analysis. Then changes in depreciation rates, okay, this is also changing per year, okay. Then extension of various government subsidized projects, like example rural electrification, okay, this can also alter. Then general employment trends. So for example, if the government changes the salary scale, so each and every company has to go under the MSME or large scale medium scale energy sectors regulated by the governments. So there is a pay scale for every type of industry, for every type of worker that are been accumulated by the government and to be incorporated by the industries. So if the government changes the salary scales, okay, salary. Suppose right now the basic is 15,600. In the upcoming year, if there is a seventh pay commission, okay, uh, is liable, then it will become 18,000 and so on. So this changes in the salary structure can also affect the risk and sensitivity analysis. Then energy price change, okay, energy price changes is very important. If the energy price changes, it can also alter the risk analysis and sensitivity. And lastly, the technology changes. Okay, now the main thing or the advantages of this sensitivity and risk analysis is that the sensitivity analysis will bring changes in various items, okay, various items in the analysis of financial statements of the projects, okay, which in turn might lead to different conclusions regarding the implementation of projects. So this is very important and crucial in case of implementation of the projects, and we are going to, if you are going to go through a particular conclusion of the project, the sensitivity and risk analysis is very important. Okay, so up to this we have completed the chapter number 6. Okay, this was the last point of this chapter.